Let's talk about the selling today. We want to bring in Ryan Payne. He's a Payne Capital Management President there. And we have Christian Ledoux, CAPTRUST Director of Investments. Christian, let me start with you. NASDAQ off just over 5%. S&P having its worst day in about 2 years. What's your takeaway?
Well, important to note, like you said, we're about where we were about a week ago. So this was just the market getting a little ahead of itself. And, at CAPTRUST, we took a little bit of money off the table on equities about a month ago for the same reason. And we don't see any reason to put that money back on yet. But we do see some positive implications, believe it or not, in the inflation numbers. So more to talk about there.
Ryan, is this the type of sell-off you expected?
I mean, I was a little surprised with CPI coming a little bit higher than expected. And I was a little bit thrown off by the amount of selling that we've seen here. But again, right, we're back to where we were over a week and a half ago. And I think more importantly, you got to remember, all those CPI numbers are backwards looking. And if you look at inflation on the ground floor, if you look at everything from what commodity prices have done, right, they've come down significantly over the course of the last couple of months. Shipping costs have come down like 60% from Asia to the U.S. I think inflation is still coming down. And I think bottom line here is if inflation does come down, the Fed could get a lot less hawkish later this year.
And Christian, you said that you had a little bit of hope, a little bit of optimism in a few spots there. I would like to know what those are.
Well, and I think it was Ryan. He just said that pretty well. You see the commodity prices coming down as we speak. And don't forget this inflation report, just take gasoline, still had a 25% year-over-year change in gasoline prices. But we know that it's come off 20% off the highs, even more than that. So we're going to see the deflationary impact of that in future inflation reports. So we need to see the market get a little bit more comfortable with the direction. And unfortunately, this did not extend the downward direction in inflation numbers, but the underlying elements are there to give us a lower inflation number sometime later this year and especially early next year.
Ryan, what about the economy? Do you think the economy is going to be able to hang on here if the Fed, in fact, is very aggressive? I know you were saying maybe they'll be a little less hawkish by the end of the year, but over the next month or two, how does that set up the economy heading into 2023?
Well, I think the market's already priced in a lot of this inflation, obviously, that we see the Fed, how they're going to raise interest rates to the end of the year. I keep going back to the employment market. The employment market is so strong, right? I mean, at the end of the day, we still have for every 2 jobs, 1 person's looking. We saw that JOLTS report. We have over 11 million job openings. And I just don't see that getting any better. I mean, every economist and strategist keeps talking about how they're going to see unemployment go up again. I don't buy it. If you go to a convenience store, you go to any restaurant. I mean, some restaurants can't even stay in business because they can't find people. So I think labor is going to stay very, very tight. Wages are going to stay strong. And if inflation's coming down, that's a pretty decent economy. And I think what you're seeing with the market right now is expectations about the economy are so low that when we find out later on that the economy is relatively strong, that could be a huge tailwind for the market here going into the end of the year. I'm relatively bullish here, even with today's sell-off.
All right. Christian, a lot stands out in terms of shelter today and the massive increase in rents. How tough will that prove to tame for the Fed?
Well, the Fed doesn't really have to do a whole lot from here to tame rents. Unfortunately, it's a very lagging indicator because real estate transactions are just less frequent. But the underlying cause of deflation in housing prices is already in. With mortgage rates getting to 6%, you've seen a lot of backing off of buyers in the real estate market, and that's going to lead to lower prices eventually. It's just a matter of time. And I would say on the food component, which was also really strong today, the initial reaction of a shopper at a grocery store is to complain about higher prices, but buy pretty much the same stuff that they always have. But as that lingers on, you're going to see consumers get a little more picky and start picking the items that are a little bit less expensive and on a relative to a year ago basis. And you could see the food element come down in future reports.
And so, Ryan, I know in your notes you talk about sentiment being the biggest variable here. How would you characterize market sentiment right now and how that might perhaps affect some of the movement that we'll see going forward?
Oh, it's not pretty. If you look at it right now, I mean, sentiment's probably abysmal. It's some of the lowest sentiment I've seen in my career. If you look at that AAI weekly sentiment indicator that comes out or survey, it's at I think it's the lowest reading, the 24th lowest reading since the survey came to existence like 30 years ago. So I think sentiment's abysmal right now. You've got money managers sitting with way too much cash right now. Looking at like when the dot-com bubble burst or when we were at the bottom of the credit crisis, we're seeing those type of cash positions sitting. So I think your bigger risk here, and I talk about this in my podcast, Payne Points of Wealth, maybe the greatest financial podcast in the country, but I digress, is, if you get some positive news here, there's a lot of money that has to get into this market. You could still see a bona fide melt up. So I think, look, you got to get invested now. Dividend yields are going up this year. It's a great inflation hedge. At some point, this volatility is going to start to subside. A lot of bad news is priced into these markets. Your bigger risk here is surprises on the upside, and then a lot of money has to come in this market. I wouldn't want to be behind on that trend.